Welcome to The Explainer. Today, we're going to unpack the latest earnings report from industrial giant Flowserve. And trust me, there's a really fascinating story hidden inside these numbers.
All right, let's dive right in. So Flowserve's latest report, well, it's kind of sending some mixed signals. It's like a puzzle with two very different pieces.
So, on the one hand, they absolutely crushed it on profit. I mean, they blew past expectations. But, and it's a big but, they missed on revenue. It's that classic good news, bad news situation, you know? It really makes you scratch your head and wonder what's really going on here. And I mean, the profit story is just wow. Their adjusted earnings per share, which is really just a key way to measure how profitable they are, shot up by a whopping 59% year over year. That's a huge jump. It's a massive signal that the company is running super efficiently.
But then you flip the coin over. Their sales, their revenue, came in about $40 million short of what everyone was expecting. So wait a minute, how can sales be down, but profits are through the roof? That's a big question, and that's exactly what we're going to get into. Okay, to get to the bottom of this, we need to pop the hood on Flowserve's business and look at its two main engines. Once you understand this split, the whole picture starts to make sense. Okay, think of it like a car dealership. The original equipment side, that's them selling brand new cars right off the lot. It's a big, one-time sale for a new project. But the aftermarket business, that's the real moneymaker. It's the service department, the oil changes, the repairs, the new parts for every single car they've ever sold. It's this super reliable, steady stream of cash. And check this out. This chart just lays it all out perfectly. The new orders, what they call bookings, for that stable aftermarket business, up a very healthy 10%. But bookings for brand new equipment, they actually dropped by 5.5%. So what does that tell you? It means their existing customers are spending more money with them, but those big, shiny new projects are slowing down a bit. So that's the million-dollar question, right? What caused that dip in new equipment sales? Why were companies tapping the brakes on these huge projects? Well, according to Flowserve's leadership, it's not that the demand disappeared, it's all about timing. Turns out, some customers just delayed their big projects, and there were some hiccups getting materials. So all that revenue they were expecting in 2025, it just got pushed into next year. The key thing here is, it's a delay, not a total cancellation. Okay, but here's where things get really interesting. Flowserve isn't just sitting around waiting for those projects to get back on track. No way. They are making a massive, strategic bet on a whole different area of growth. And that area is nuclear energy. They just went out and announced a huge acquisition. They're buying the valve division from Trillium Flow Technologies. And let me tell you, this isn't just some small pickup. Trillium is a major player, a real heavyweight, in supplying essential parts for the nuclear power industry. This move is a total game changer for them. All of a sudden, they have access to this massive installed base of equipment at 115 operating nuclear reactors. And what does that mean? It means a huge new opportunity for that super profitable aftermarket business we were just talking about. See how it all connects? And let's just talk numbers for a second, because this is wild. For every single new large nuclear reactor that gets built anywhere on the planet, Flowserve's piece of the pie just jumped. It went from a potential $100 million to as much as $120 million. That's a 20% boost in their share of a market that's worth billions. That's a big deal. Yeah, their CEO, Scott Rowe, basically said this move cements them as the leader in this space. And think about it. With the whole world looking at nuclear as a clean energy source, Flowserve is planting its flag right in the middle of this massive long-term trend. But hold on. This story isn't just about buying other companies. Remember that crazy profit jump we talked about? To really understand how they pulled that off while sales were kind of flat, we need to go inside Flowserve and look at a radical change in how they operate. I mean, their profitability is just off the charts. They hit their big 2027 margin goals 2 years early. 2 years! So you gotta ask, how on earth did they do that? The secret weapon is something they call the Flowserve Business System. It's basically a 3-step plan. Step 1, make the factory floor as efficient as humanly possible. Step 2, use that classic 80-20 rule to focus only on the products that make them the most money. And Step 3, get way smarter and more targeted with their sales. And is it working? Oh yeah, it is absolutely working. This new playbook delivered a jaw-dropping 16.8% adjusted operating margin in the last quarter. It's just proof positive that by getting leaner and meaner, they're squeezing more profit out of every single dollar they make. So where does this all lead? We've seen the internal changes, we've seen the big nuclear bet. How does this all fit into their grand plan for the future? Let's talk about their targets for 2030. All right, looking out to 2030, Flowserve has put some really bold new targets out there. They're talking steady sales growth, which is great, but get this, they're aiming for a 20% operating margin. That's huge. And they want double-digit growth in earnings per share every single year. That's not just confidence. That's a serious statement about where they think this new strategy is taking them. So when you step back, it's pretty incredible what's happening here. Flowserve is basically rebuilding its engine while speeding down the highway towards a nuclear future. They're getting hyper-efficient on the inside while making this massive bet on the outside. And that leaves us with the big question. Can this new playbook, this new strategy, actually get them to where they want to be in 2030? Can they pull it off?